We'll see if somebody joins. Yesterday I think we got up to like 5 people at one point. It's pretty amazing. So I think we figured a few things out. We're connected to more socials, so maybe we'll get 6 or 7 today. What's going to be a bigger draw today is we have Jesse with us. That might help the attendance also, but we're using this as an opportunity. The industry has evolved, it's changed so much in the last couple of years, and we have these conversations about the next evolution of the industry, where we're going, what might happen. But we thought we'd go live so we can share some of our thoughts, but most importantly, get some thoughts from other people in the industry as to what they're seeing. So, with all of that, I want to kick this off with a question, and I'll start with Cody because he's anxious to share. Like, why did you join MFG, and what are some of your thoughts on the evolution of the industry at this point?
Um, there's several reasons I joined MFG. I would say the main one
Was
is
Craig? Was it because
yeah,
of Craig?
Craig, 100% Craig.
Thank you. Thank you.
Yeah, I saw, my goal in life was to get muscles, and I saw Craig and Troy, and I was like, well, I guess if it's bulking season, I guess I could go to
So
MFG.
work out a ton, shave your head. You've got the facial hair started already. So
Yep.
But no, I would say the number one thing was transparency for me.
yeah,
In a business, in a business with where transparency is pretty much non-existent, it's very rare that you find people that are willing to talk to you about the real numbers, not just the fake ones they want you to see.
right.
I would say that's number one for me.
Yep. So within that, and I'm assuming you're talking about margins and pricing and those types of things too. And I don't want to go down a huge rabbit hole on this. We got a lot to talk about today, but
Now go down the
I'll
hole.
today.
Go down the
I'll
go down the
hole.
rabbit. Oh, we're gonna. Okay, all right. I love it. JP,
It's
JP,
Friday.
let's go.
The hole needs dug.
So with that, and all three of us have talked about it, is pricing comparison. All three of us came out of the retail world and we compared pricing. I did it again this morning with a candidate, comparing pricing to his retail model, and the pricing's significantly different. Is that fair?
Significantly.
Yeah, we're talking, and I don't remember the specific examples, but most people I talk to, it's 100, 150 basis points, a few even more basis points worse in price with their competitor, with your former employers, or with,
Hmm.
let's not call anybody out specifically, but just compared to retail, we're generally 100 to 150 basis points better.
Mhm.
Well, and some of these companies also have a wholesale branch. So not only is the retail loan officer having to compete just for the business in general, but then they have to go compete against their own wholesale channel where brokers are actually sending business there, and it's still 100 basis points cheaper. So
Mhm.
you have the double whammy, right?
Mhm.
You're
So
competing against
I'll,
brokers,
I'll
and then you're competing against the wholesale on top of that in your
well,
own company.
Mhm.
and go look at any wholesale company. The majority of them are at break evens or losses. Majority of them right now, just where the industry is. So who do you think's paying for that difference?
Right. I mean,
Yeah,
that's a good.
well, that's
The LOs
yeah.
and the clients. It's one thing I've learned in the last 6 months is the only person who's bearing the expense of the margin compression. Well, there's two, the client and the LO. And that's not to
Yep.
say that there aren't companies who are making some efforts and some who are like making some adjustments. But interestingly enough, someone in retail told me, you gave me this brilliant little phrase, there's a lot of money to be made by keeping people in the dark. So,
Oh, quote unquote.
yeah.
Right. All right. So shifting gears a little bit, Craig did a great job of putting some bullet points together this morning about some great talking points. I like the one, especially for this one for you two. How are you helping real estate agents succeed in this market? And I know you both are doing some pretty unique and fun things. So I'd love to hear about it.
Cody,
Go ahead, Jesse.
you got a smirk. You start.
You go ahead, Jesse.
He's always got a smirk. That's just
That's
how he
true.
is.
That's fair. That's fair.
You never know if it's a
Makes you
smart
think he's
aleck
always
comment
up.
or you never know.
I mean, I think for on my side, it's a couple things. It's an affordability push or play. It's really not even a push. It's just kind of like, I mean, I could give direct examples where closing costs, the exact same scenario. I mean, and I've never really been one to lead with rate because I think the price is always too high until value's been established, period. Whether you're charging $1 million or $50, until you've established that value, then the price is always going to be too high. But when we're talking about $600,000 loans, you know, an eighth or a quarter or half a percentage point matters, but also from just a cash out of pocket expense, par rates, like that didn't exist for the last 18 months. So that's pretty refreshing. You know, I could probably come up with a pretty cool spreadsheet just about like the dollars saved in, you know, a very short period of time here over the last week. But so an affordability play, helping clients to not need to tap into their 401k and their savings or investments to go to closing on the home, whether or not they need money or not. That's pretty massive difference. And then even stuff like picking up a DSCR loan. So I had I hate to make this a retail bashing thing, but a retail lender dropped this loan 4 days before closing after sitting on it waiting for an exception for 2.5 weeks. And we were able to pick it up and it's already in with underwriting, you know, 24 hours later. So.
Well, let's
Yeah,
add
I don't.
a second real quick. I mean,
Sure.
Jesse, you know, I kind of helped you with that one as well. And one of the things that was, I think, eye-opening for you is how much the account executives want to help you out with helping you with details of that scenario. But also we shopped it around to what, like six different investors to see which one was going to be the right fit for that specific situation, because it was a unique situation.
And it is, right, exactly. And so, and I think what I've learned, you know, the contrast between these two environments is that when you're in a more retail environment, even if you can kind of piecemeal here, it's the highest common denominator. They're never going to choose the lowest common denominator. They're going to choose the highest risk level that meets the pool of investors that they're working with. So if you have an investor out of 6 on a DSCR product that doesn't allow first-time investors, then the whole pool is going to follow that overlay. Whereas in this environment, you can place it with the one that allows 75 LTV for a first-time investor with credit over 700 and, you know, likes to eat eggs on a Tuesday. So it's very flexible.
On a Tuesday. I love it. That's very specific.
It was.
And I think that.
Go ahead. I'm sorry. I was going to say one thing she said that I wanted to go back to, because I haven't remembered this until she just said it, is no rates at par.
Mm-hmm.
That is surprisingly a really, really big fact. I mean, because as a loan officer right now in this market, like we all have a general consensus that rates are not going to stay this high forever. And so buy down points are a really big deal to loan officers that care about their clients.
Mm-hmm.
You know, because you know that the break-even point is probably not going to be met on that money.
No.
And I remember when I made the transition from retail to here, it was at the height of rates. You know, we were near an 8%, and I hadn't seen a par rate in 6 months.
Right.
And I got here, and I was like, I can price out a loan with a lender credit. What is happening?
Like, and that's a big deal to a consumer who, you know, to Jesse's point, that's a big deal to a consumer to have to bring 50 or 100 basis points to closing when they may or may not already be tight on cash. And 50 to 100 basis points, you know, in a $400,000 loan example, that's another $4,000. It's a lot of money.
And majority of the time, I was eating the cost majority of the time, because
you're taking it to your P&L.
Yeah, I couldn't live with charging the borrower points for a 7 3/4. Yeah. I could not sleep at night, so I took the hit.
Well, there you go. It's interesting. The industry's evolved, like you said. So, and we see so many people, and I agree, this isn't a retail bashing session, but the fact remains that the industry has evolved, and there are a lot of people moving from one side over to the wholesale channel. And the thoughts of, you know, the bigger companies have always said the wholesale channel is not effective because they can't close deals on time. They're not effective at doing the difficult deals. And Jesse, you've just proven that's the exact opposite.
Mm-hmm. We got to follow the money.
Mm-hmm. Yeah. I have a question for Jesse. So what's been the biggest aha for you since switching over? Like, as far as the customer service standpoint, what's been the biggest difference or the biggest surprise to you so far?
Well, I'm a chronic consumer of content, so I think I unraveled a good bit of this leading up to actually making the change. But I think the willingness of account executives to jump in, which is exactly what, and I will throw retail under the bus for this one, they preach against and they proselytize against and they drill it into your head that this is, this is not going to be an environment like, oh yeah, you're throwing spaghetti at the wall and hoping something sticks and you're just, throwing it out to the ethers and hoping it comes back down before closing. And I mean, I understand if you stand to gain, another 1 or 2 points in your bucket from keeping your LOs from learning that, then surely, but it's just not that. And no system's perfect. And I can tell you that in both environments, I mean, the retail underwriting environment is not perfect. And there were many days that I sat and like quite literally cried tears of panic waiting to hear from a retail operational chain. So, I don't know that anyone can sit on a high horse in this case. But yeah, I think the willingness of account executives, I mean, look, they work like us,
Yeah.
they want to help get families into homes. They want to make sure the transactions close on time, because if they don't answer the text and if they wait overnight like that just like us, it affects their reputation and their street cred inside of this environment.
If the deal doesn't close, they don't get paid either, right?
Yeah.
So they have every incentive to take that text at night and help out at every level. You're right.
Mhm.
The other thing I would like to add to that, and Jesse, I know you've experienced it firsthand, is being able to go straight to the source, right? Go to straight to the underwriters, straight to the account executives and say, hey, what do we need to do? What documentation do we need? How do we structure this file to make sure it goes smooth and stress-free? And I think that that's one of the things that, the retail channel doesn't like, is the fact that, we can go to the source. We can actually go to the underwriters and walk through details with them to make sure that we're all in alignment with each other as far as how this file is being set up. And, I've always found that the more transparent you are with underwriters, the more they're going to work with you, and the easier it's going to be to get those files done. And, that's the one thing that I've enjoyed for 17 years is being able to go directly to the underwriters and really, figure out solutions to, situations. So, because we're a solutions-based company.
I think we need to do like a Mr. Rogers style field trip. You know how you would take the kids through like the crayon factory or whatever? We need to take you non-retail folks and like take you through like the food chain of a loan manufacturing over there and do it Mr. Rogers style.
I'm sweating right now.
One thing I compared it to,
I've had hundreds of transactions that were perfectly fine, but when the argument is being made so loudly by the side of the spectrum that stands to gain the most at the top of the food chain for making those arguments, I don't know, follow the money.
Yep. One thing I compared it to yesterday is sometimes as a loan officer, you feel like you're on an island when you're trying to get a deal closed. It's like you're the only person on planet Earth that cares if that loan closes on time, is what it feels like in the moment. Like you're like, I got to figure this out. Nobody will help. Nobody cares. Nobody wants to help me figure it out. And then the broker channel is, hey, let's all go. We can all go cry in the corner, but we're going to go do it together and figure it out.
Mm-hmm.
You don't feel like you're on that island. That was the best way I knew to explain it, because it does feel like that sometimes.
And I feel like we do a really good job of, and this is one of the things that drew me to this company, we do a really good job of making sure people are not on an island. I mean, the chats that are going on all day long about, hey, did you know that this lender can do X? Or where would you place this loan? Or have you guys run into this? It's all day long on the Teams chat, people helping each other, and that's huge.
Mm-hmm.
So to say, and I said this in my prior years, I said this all the time, that you're not going to get the support levels on the wholesale side. Retail's better. And it's just not true. That's not true either. So the other thing that I heard, and this rolls into my next question, was that on the wholesale side, you just don't have that much marketing support, right? So retail is better because you have marketing support here. Well, in a world of digital media and the technology that's evolved, that's simply not the case. So my question, either one of you jump in first, how has social media helped you to expand your business? And I know you guys have done and are doing some unique things in that space. So curious to have you guys share that.
For me, I would ask you, when is the last time you were scrolling through Facebook or Instagram and saw a picture of a bland house and a made up family, and you looked at that and you said, you know what, I think I'm going to do business with them today. I really like that graphic. I really love that.
Mm-hmm.
When is the last time you've scrolled through and done business? Like, you know, all of the bland posts and they might have worked 15 years ago, but they don't anymore.
Mm-hmm.
Right now, it's just noise. Like, let's be honest about it. It's noise. And the fact that at the end of the day, customers and loan officers in retail are paying for someone to do a horrible marketing job.
Mm-hmm.
We'll call a spade a spade.
Yep.
The majority of them, like today, it's all about personal brand. And I know Jesse and I both are pretty active on social media.
Yep.
That marketing girl sitting in another state that's got the job and just makes these bland posts, she's not your personal brand, and nobody's going to use you because you use those graphics. So I would challenge you to say that that's nothing but eating up margin. If anything, that's not marketing support.
Yep. So Cody, you and I are.
Sorry.
Go ahead.
No, Brian, I'm sorry.
You and I are in a couple or have attended several workshops, you know, the same workshops. We were in the same mastermind for a while. And to a T, they'll say that sort of canned digital media, canned marketing, just it doesn't work. It's not effective, but it's more about personal brand and how you become known as your authentic self versus pushing the company brand. And what I love about MFG is we truly buy into the idea that your brand is more important than the company. So we're a platform that provides a service. You guys are the brand. The loan officers are the brand individually.
Yeah. Yeah. It's like, I mean, look what's happened in companies and corporations. Like, just look at marketing and advertising in general. Like, you don't really see TV commercials anymore. Like, everything's gone to influencer style. And I know that word's kind of taboo and everybody hates that word, but it's the truth. It's gone to influencer style marketing because people want to buy and follow from somebody they know, like, and trust.
Mm-hmm.
At the end of the day, that's what they want. They don't want I'll keep it PG. They don't want some jerk in a suit and that just sits at a desk that they don't really know who he is or what he does, or, I mean, they don't know him personally. And so I think that's just like, at the end of the day, it's a margin eater. It's coming out of the loan officer's paycheck or the customer's pocket.
Yep.
Yeah, there's no amount of postcards that can justify, another 150 basis points to a veteran, right? Trying to buy their first home that's tapping into their TSP. Like, I don't need postcards that bad. And to your point, Cody, the marketing rebellion, Brian and I actually read this book over the last month or so, last couple of weeks. The whole premise of that book is, and it's great if anyone is into the nerdy, like, marketing things, but the entire thing could be summed up by saying the most human company wins. So I think the evolution of the industry requires that. The more technology tries to, like, be this truck running down the road to, attempt to run over. I know realtors are concerned about it, and some LOs feel like AI is going to edge us out, but there's no way I'm going to want to consult with a robot. Sure, it can generate, like, a rate quote or a fee estimate or whatever, but, like, the more we can be human and the more that we can make that entire process relatable, I think it's critical. And yes, there's something to be said for, like, an omni-channel approach where you do incorporate some other things, but it doesn't feel like that's going to be what helps a loan officer to persist through a changing market.
Absolutely.
I think when it comes to consumers, they still want that personal touch, right? And I don't think any technology out there is ever going to be able to replace personal touch. And even on the underwriting side of it, there is still personal activities that you have to do to make sure that everything goes smooth and stress-free for that consumer. And again, no matter how much AI you have, it'll never be the same experience, in my opinion. So
no, we'll see where it goes.
We'll see where it goes, and we'll see how
I always like to look at you guys know what Barstool Sports is, right?
Yes.
Barstool Sports. Like people hate them or people love them, but people love them because they're just a bunch of guys and girls. Just some of them are obnoxious, some of them are not, but they're just being themselves. They're just being human, and the people that do like them are freaking in love with them.
Yep.
And they have.
And by the way, the people that don't like them still watch them.
Yep. 100%. 100%.
So yeah, the Marketing Rebellion, the book that Jesse just mentioned, she recommended the book to me. I did listen to it on Audible. I shared the link in the chat here, but for anybody that's interested in learning it. But yeah, the whole premise is, like Jesse said, is taking marketing down to the local level and meeting people authentically where they are. Like that's the whole premise.
Mm-hmm.
And I think personal brand is the perfect example of that, right?
100%.
Absolutely is. And I think at the end of the day, I think 5 years from now, I think a lot of people that don't have a personal brand for the most part they'll be non-existent, or they'll be small enough to basically call them non-existent.
Mm-hmm. All right. So next question. What excites you about heading into 2024, and how are you preparing for it? So you're both, in transition, you're getting settled in, new opportunities, new platform. I know you guys are preparing for 2024, which is going to be a good year in the industry. What are you doing to prepare for that?
Well, I mean, what I'm doing is trying to learn all the things, which is kind of my jam in general.
Mhm.
Like, and I think it's worth saying that this platform is totally not for everybody. Like, if you don't want to be, this is going to sound like a jab, and it's not, but like, there are some people that just want to like show up and like have things kind of like status quo and everything's good. And like, we don't want to rock the boat, and that's fine. And there's probably a great like mid-level market that works for those personalities and then the clients and all that stuff. But if you want to be able to like set a BHAG, a big, hairy, audacious goal, like, and you're resourceful and you want to leverage the tools and you have like, the inclination to try something new, you can actually like stop and implement and just do. I think that's part of the allure here, is that you can just do, and there's not going to be like, and it's not about being non-compliant, but you're not going to have all these like this bureaucratic framework that keeps you stagnant and prevents you from being able to just kind of be in creation mode for yourself and for your clients. So I'm really trying to lay the groundwork now. I had some folks that I was talking to that said they're in retail and they're stressing, I'm like, oh my gosh, it's the holidays, but I got to try to get these last couple closed, and I don't think I should move during the holidays. And I'm like, okay, well, now we have the good CPI data. We have a softening job market. We have rates starting to, I'm not going to say it out loud because rule number one of Fight Club is you don't talk about Fight Club, but like things are trending in a way that we've been kind of like hoping they would start trending for a while now. So if we wait until January or February to make a change into this environment, then you will be behind the curve when refinances start cracking off, or when the spring market comes, or we're touching down into the fives. Then you're going to have a much harder time. It's not going to be impossible by any means, but I'm really excited to be doing this now so that we can all like be ready to take advantage in the most helpful way. Like, I want my clients to be like feeling confident writing an offer in the spring with knowing their rate is half a point lower, knowing they don't have to come up with an extra 3 to 5K to close. And I'm going to have all my systems built around that 5-star client experience, because I'm going to understand exactly how all this works. I'm going to know how to push buttons on all the resources. So it feels, at top level, lizard brain stuff, which is really bottom level, when we're talking about Maslow's pyramid of needs, like that, like food and shelter, lizard brain stuff gets really triggered as an LO when you start thinking about doing something new and scary. But you cannot get to self-actualization if you are constantly going to keep slamming your hand in the same drawer, which is like, ooh, I got a load in the door. Ooh, I just lost it. Ooh, I got a load in the door. Ooh, I just lost it. So learning all of this now, and it's not like it's not push button. You have to be willing to receive all of the different forms of input and all the different resources. But gosh, am I glad that that's going to be the case come January 1. I mean, come December 1 at this point, you know what I mean? That's what I'm most looking forward to.
I would say for me, to touch on a couple of things she said, number one is the first thing that came to mind was the refis. So the reason I left my last company was because we had, I think it took 4.5, 5 business days minimum to get an initial underwrite, if I can spit it out.
I remember you telling me about that, and that was even in a slow market.
In a slow market. So my thought process was, okay, what do we do if rates come down tomorrow? Like, what's going to happen? We're going to have 60-day refis like some companies did in 2020. You can't compete at that. Newsflash, you'll lose deals. And so I knew when I asked them, like whenever I asked them, like, what's your plan with underwriting? They're like, oh, we'll hire as the volume comes in. And I'm like, yeah, I'm out. That's recipe for disaster.
That's your plan.
And I say that to transition into, you have to plan for the future always. And if you're a loan officer, a slowdown is a time to recreate yourself or rebrand or make a change or try something new. What is I would challenge anybody to ask themselves, what is the worst thing that could happen? If you made the jump, what is at the end of the day, what is the worst thing that can happen? You've had a loan gone wrong, so you've that's already happened to you before. That's the worst thing that can happen. Like you can always go back. If you hate it, you won't, but you can always go back.
Yep.
And so
I love that.
Slowdowns are a time to recreate, rebrand. It is, I don't like the word, but separation season is right now. Like, we all
like that. Why don't you like that?
Do what?
Why don't you like that?
It's overused. It's overused.
I've never heard it before, so it must just
separation season.
I haven't heard that either. That's a new one for me. I'm going to write it down. I'm going to use that.
Oh, well, I guess I follow too many like-minded people on social media, but like, we all know that December, January, maybe not December, but January and February are the slowest months for a loan officer historically. Always.
Yep.
Literally always. You always have downtime. So instead of using that, wasting it so that you can just go back in March and slam your hand in the same drawer, like Jesse said, why not try to do that? Like, if it could literally change your business, if it could save your customers money, if you could take better care of your agents, your realtors, and maybe have a little less stress at work, or a few deals here and there that don't go as bad, why? Like, I don't understand why you wouldn't.
Yep.
Cody, you bring up so many other sidebar conversations, but you're right. November and December are probably the most important months in your entire 12-month period of being a loan officer, because November and December set up the first quarter. What you do today and next month sets up January and February. And just like you said, January and February are probably one of the hardest months to get through, especially because nobody wants to move in the middle of winter, at least here anyways.
Yeah, you guys, it's 70 degrees today here.
Awesome.
November and December set up the first quarter, and it's what you do today that impacts everything else. The other thing that you talk about, and Jesse, you've experienced this as well, is really sitting down and building out your business plan for 2024 and mapping it out and walking through all the things that you want to do to continue to expand your business. And that goes back to now scalability. In your previous companies, were you able to scale your business like you will be able to scale your business here with the technology that they say you don't have, with the support that they say you don't have, with the options as far as loan products go that they say that you don't have? I think one of the biggest things that we have here is each one of you can scale your business very quickly, just based on all the other things that we can offer. And then we go back into, how are we setting up, 2024? Well, we're continuing to dial in the CRM, right? That's going to be crucial when the refis hit. If you don't have your CRM dialed in, then that's going to be one of the biggest failures that you're going to have as a loan officer, because if you're not reaching out to those clients, other people will be. So you have to have your CRM dialed in. And then the other thing is, I'll take this from UWM, speed solves everything, right? The more we can continue to keep fine tuning our process, the better it's going to be. Even if that means we're operating right now at 12.7 business days for clear to close. If we can get that down to 11 or 10, well, that's amazing. And, the biggest thing is really trying to dial in all your systems right now, prepare for the future, make sure that you're able to scale, make sure you're able to handle the volume. Because one of the things that I learned, my hardest lesson was, 3 years ago was, how do you handle 50 new files coming in, and what does that support look like? And it's going to get to that point where you guys are hitting 40, 50 files a month just on the refi side. Plus, then you also have to throw in the purchase side because, as we know, interest rates are going to come down. The people have the 2 and 3 and 4% rates are eventually going to put their houses on the market. So now you're going to have an influx of not only refis, but also purchase business. And so everybody needs to dial in their systems today in preparation for that.
Yeah. And just to touch on that, one last piece is like, as an originator, when I was sitting there, when I decided to make the change, and like, as you guys all know, I'm very dramatic. So of course my change was like in a day, like I thought it, and it was like, okay, I'm out. But like, that the model is not sustainable. And if you're a retail originator and you're just a loan officer in an office, you don't have a branch, obviously there are certain situations, but for the most part, like deep in your heart, that it's not sustainable. It's in some capacity at some level that there's somebody making more comp. There's somebody like there's people that have their hands in your pocket. I know you feel it. I know you see it. It's just that how long are you going to live in that denial? I lived in it for a long time. And
I think a lot of loan officers do that, Cody.
Yeah,
you're right.
Because just like Jesse said a minute ago, oh, I got the loan. Oh, I don't. Oh, I got the loan. Oh, I don't. I think you guys seen that commercial with the old guy with the dollar bill. Oh, you almost had it. Like that's the way every loan officer lives their life. And they're like, they're just chasing this one loan, and it's this constant roller coaster always. But it's like, the model is not sustainable.
Well,
if you're growing, it's not.
I want to answer your question differently from the beginning, Cody. You said, what is the aha moment? And I had it a few days ago, and I texted one of my friends, and I was like, oh, damn, I kind of feel like Stella got her groove back. Like the confidence factor. I think I'm halfway smart. I'd like to think I'm good at my job because I care so much about what I'm doing. But I feel like all of a sudden it's like, oh my gosh, like I remember this feeling. It's like, okay, we can do this, and you can relay something with confidence as opposed to the feeling that like you're walking down a hallway lined with like doors on either side, right? And so it's like you're walking. Everyone's seen the episode of Family Guy, where what's the dog's name? Brian. Stewie gets to punch Brian because Brian owes him money, and but he doesn't tell him when. And so Stewie just walks around being like, like flinching, and so Brian is like constant fight or flight, the dog, right? He's constant fight or flight. I guess retail LOs, you're just walking down that hallway, like, oh, someone going to pop out of that one? Like, am I going to lose that one today? Or is this like overlay going to come down? Or is this change going to happen? Or is this tiered pricing going to come down? So I think like that hugely impacts your confidence. And newsflash, as salespeople, we like to feel good. We are people pleasers. And so if you're in an environment where you feel like crap, you're not going to be able to sell. You're not going to be able to sell with confidence, and you're not going to feel good like day in and day out. And that's, we haven't even talked about that. That's a whole nother thing, like how you feel and how much that dramatically impacts every single aspect of your life, health, sleep, like your relationships, all outside of just your ability to deliver that experience to your clients. When you feel good, when I can confidently tell my client, like, listen, this is, you're in a great spot, and they can feel that instead of me going, please don't shot me, please don't shot me, please don't shot me, please don't shot me, which is a crappy feeling.
Oh, that is so like that brought up like so many, like feelings that I forgot about, because when I was where I was before, I remember like I almost felt like I didn't want to do loans. That's horrible to say.
Mhm.
That is a bad feeling as a commission only employee.
Yeah.
I felt like if somebody came to me for a loan, that I knew in my heart I was not the best option probably.
Yep.
Because at the end of the day, now majority of mortgage companies have similar service. A lot of it's the loan officer. You know, there's differences in underwriting and stuff like that, but for the most part, they have a similar experience.
Mhm.
No matter where Craig goes to do a loan, they're probably going to have a similar experience, no matter who he works for, because he is who he is. And so it's just positioning yourself as a loan officer to put yourself in the best scenario to where you can take it to whatever lender you want. But at the end of the day, you can't sell something you don't believe in.
Mhm.
And that's crucial, because everybody here on this call are people of integrity. And to me, and I think you guys all agree, is if I'm trying to sell something I don't fully believe in, I'm out of integrity, and it feels like lying, right? So I think that's kind of what you're getting at is, there's better opportunities for your clients. And now you're in a space where you can give your clients the best opportunities, the best rates. Now you're selling from a place of integrity, of confidence, and it's a whole mindset.
Yeah, like that. That's the reason I walked out of my last company, is because it was literally one day and it was one particular client. And I go, you know what? This crap stops right now. Like it stops right this second. I won't do it
And,
another second. I would rather be poor and broke as to put a client through this.
and didn't you say, you told me that story? Didn't you resign on like a Friday afternoon with no
Yep.
plan?
No plan. I had no plan. I
I
just
love
said
it.
that I literally said, this is not who I am. This is not my character. I said, this stops right now. I don't care what happens to me, but it stops right this second.
Yep.
I love it. Great
I
job.
remember.
Phil just made a really great point on LinkedIn. Phil says LO knowledge and their relationships with lenders are what separate good from great. And that's exactly what we were touching on earlier in terms of being resourceful and having that knowledge. But when you feel confident in the knowledge that you're getting and that you can implement it, then it's like a total game changer. Instead of feeling like, well, what side of the bed did the underwriter wake up on today? And are we going to do this as, this form of income or that form of income? Like the subjectivity leaves a lot.
Yep.
There's
Yep.
a couple things here as well. With the mindset shift, you're able to get out there and crank out the volume, and volume cures everything to some degree, right? But because you have the confidence now that you have the tools, you can get out there and increase the volume. And I think one of the biggest things that we've all experienced before is change, right? The uncertainty of change. And, going from the retail side to the wholesale side, there's change, right? It's not easy. You're scared of the unknown, but I always say this, that change is helping you to become a better person, right? It's an evolution of the next. And sometimes you have to make that change in order to create the next story, the next chapter in your life. And I think both of you, I'm very proud of the fact that you guys were open to change. And because of you guys making that change, I feel like you guys are going to continue to evolve as loan officers. I think you're going to continue to evolve as far as being able to, help other loan officers continue to grow their business as well, because, you've experienced everything now. You've experienced the retail side. You experienced the transition change, and now you're on the broker world, and now you get to experience all the other possibilities here that you weren't aware of in your previous situation. And so I'm very proud of the fact that you guys have both taken the leap of faith, is what I like to call it. Yeah. And I think that's very important.
Yeah, I mean, at the end of the day, if you're a loan officer and you are who you say you are, if you really have your clients, if you have a fiduciary responsibility, well, I'm going to tell you something. You don't have any integrity if you don't look into other options. Mm-hmm. That might be harsh to say, but if you are who you say you are, and you actually have a fiduciary responsibility to your clients, You have no integrity if you don't look into every option available.
At least look, right? Like you bring
Yes,
up a
you
great
don't have
point.
to. You don't have to do it, but you have to look. It's your responsibility.
Especially if you know that you consistently are losing deals, right?
Yep.
There's typically either, it's either you or it's, the products that you're unfortunately have to sell because you don't really have control of the decision, right? And so you get put into these pressure cooker situations where, well, I don't think it's me because I continue to keep losing out, and I'm not losing out by 1/8% or a couple $100. I'm losing out by 0.5 point and $4,000 in additional closing costs. And that's very frustrating, especially if it's a repeat offense, right? It's one thing, okay, I lost a deal. I get it.
Happens to everybody once in a while, right? Like,
right. When you lose 5 deals in a row and you're not even in the ballpark, well, that's a concern. That's a concern at that point in time. It's like, wait a minute, what's going on here? We need to pull back the curtain a little bit to see, how can we shore up the situation a little bit more to where we're not losing deals? Because I think one of the biggest things that management forgets is you, myself, Cody, even Brian, we're in the trenches every single day, right?
Yep.
We're doing the work. And sometimes I feel like, some of these upper tiers of management get so lost in the day-to-day that they forget about what it's actually like to be a loan officer on a day-to-day basis. And they lose touch of all the feelings and emotions and struggles and wins that we share every single day. And I think that when you have a manager who's completely out of touch and all they're doing is putting pressure on you to perform, given the products that you have to offer, and you continue to keep losing deals, but then when you go to management to say, hey, my experience, this is what's happening, like, sorry, just sell more. Or sorry, these are the rates.
Sell a higher rate.
Like if you're in retail and you think you're selling high rates because you have better service, you're lying to yourself. You're lying to yourself. Like, just stop today. Stop lying to yourself. It has nothing to do with service.
Yeah, and to circle back on something Cody said a minute ago is I've talked to a few actually recently, people that have been in the retail space for 10, 20 years, long time, said, I would never work for a broker. Well, why? Well, I just never would. Well, to Cody's point before is, why wouldn't you at least look at it? Maybe you won't do it, but it's at least worth a look. And I do think we have that responsibility to our careers and our clients.
Yep, 100%.
I'm going to back cop it and still say, though, like this isn't for everybody, because maybe everybody doesn't feel that way. And there's going to be, in separation season, there's going to be those people that just they're good. Like maybe it's not a moral compass thing. Maybe it's just an effort thing. Like there are different personalities out there. Yeah. And I'm not trying to, that's not a dig at this clearly, but like it's not for everyone. And I'm completely okay with that.
Nope. And it's one of those things where it gets worse before it gets better. Like, it's harder work right now, learning this side of the business, being in retail for 7 years. It is hard work learning all of this different systems and processes. And it is definitely more work on my part. But again, going back to the responsibility piece, I felt it was my obligation to make the transition.
Mm-hmm.
It wasn't my customers and my realtor partners should not have to send their customers to pay for a higher rate and higher fees just because I have a nice office, and just because my CEO has a second home, and just because I have 47 compliance people that can audit your file after closing. My customers shouldn't have to pay for that if they don't have to.
Right. I love it. All great points here. I love this. So what do you think? We're going to do this weekly, right? Every Friday,
I like it.
8 a.m., 8:30 Central Time.
Yeah, love it.
Absolutely.
Mm-hmm. Anything else, or should we wrap it up, Craig? What do you think?
45 minutes. They're probably getting tired of hearing us blabber.
Yeah, I would be.
I think we should. I'll end with if you ain't growing, you're dying.
There you go.
I like it.
Great phrase.
Well, thank you guys for joining today.
Guys.
Yep.
It was fun.
Thank you guys. Have a great Friday.
You too.